Something quietly happened to Bitcoin over the last 5 weeks that most people completely missed. Not because it was hidden, not because you had to dig through some obscure blockchain database or read some 40-page institutional research report. It happened in plain sight, published every single trading day, in numbers that are accessible to anyone who bothers to look. And almost nobody is talking about what it actually means. So today we are going to talk about it. All of it. Here's the number that kicked this entire video off. $3.8 billion. That is how much has been pulled out of US spot Bitcoin ETFs in just 5 consecutive weeks. 5 weeks of straight outflows, back to back to back to back to back. Every single week, more money leaving than entering. And the reason that number should make you stop and pay attention is not just the size. It is the streak. The last time Bitcoin ETFs bled for this many consecutive weeks without a single positive week in between, it was February and March of last year. And what triggered that streak back then? President Trump's surprise tariff announcements, a geopolitical earthquake, global risk-off panic that rippled across every major market simultaneously. That is what it took to produce 5 straight weeks of ETF outflows. A macro shock. And right now we are matching that exact streak without a single comparable catalyst to point to. No surprise tariff, no regulatory bomb. No exchange collapse, no bank contagion, just quiet, sustained, deliberate institutional money walking out the door, week after week. And that should make every serious Bitcoin participant think very carefully about what is actually happening beneath the surface of this market. My name is your host, and welcome back to this channel where we do not trade on hype or on what Twitter influencers are screaming. We trade on data, on market structure, and on what the numbers are actually telling us. If you are new here, subscribe right now, because the analysis we are about to walk through is the kind that most channels in this space will never give you. Not because they cannot find the data, because the data is uncomfortable and it does not fit the always bullish narrative that generates the most clicks. But you deserve the real picture, so let us build it layer by layer, starting from the raw numbers and working all the way out to the macro forces driving them. Let us begin with what the ETF flow data actually looks like when you lay it out week by week, because the pattern becomes impossible to ignore when you see the full sequence. The outflow streak began the week of January 20th. That first week, approximately $133 billion left the Bitcoin ETF complex. The following week, the selling accelerated, $1.49 billion in net outflows. That was the most severe single week of the entire 5-week streak. The 2 heaviest outflow weeks came back to back in late January, which is particularly notable because Bitcoin was still trading near its cycle highs during that period. Institutional investors were not selling into weakness. They were selling into relative strength. Then the pace shifted. Week 3, approximately $318 million out. Week 4, around $360 million. Week 5, the most recent one ending February 20th, another $316 million in redemptions. So the velocity of outflows has decelerated from those heavy late January sessions. But deceleration is not reversal. The direction is still out. And the cumulative damage across all 5 weeks sits at just under $4 billion removed from a product category that was supposed to represent the institutionalization of Bitcoin as an asset class. Now, to be precise about what those numbers sit against, total cumulative net inflows since the US spot Bitcoin ETFs launched in January 2024 still stand at approximately $54 billion. And aggregate net assets across the 12 approved funds sit near $85.3 billion, which represents roughly 6.3% of Bitcoin's entire market capitalization. These funds are not collapsing. The infrastructure is not failing. But that is exactly the point that most people miss when they see the outflow headline and immediately dismiss it. Nobody is saying the ETFs are dead. What the data is saying is that the direction has changed. And in markets, direction is everything. Cumulative position means less than the current trajectory, and the current trajectory is out. Look at February 12th specifically, because that single day tells the story better than any weekly average. On that one session, more than $410 million was withdrawn from Bitcoin ETFs, $410 million in a single trading day. And here's the detail that matters most. That was not a day when Bitcoin was in freefall. Price was hovering in the 67,000 to 68,000 range. There was no panic in the price chart on that day, which means the institutions that sent that $410 million out the door were not reacting to a crash. They were not force liquidated. They made a deliberate decision to reduce exposure while price was still relatively calm, and then they executed it. That is not capitulation, that is managed portfolio reduction. There is a significant difference. When institutions flee into panic, it often creates a washout low that is quickly reversed as the panic subsides. When institutions sell into calm, that is strategic repositioning. And strategic repositioning does not reverse quickly. It plays out over weeks or months until the conditions that triggered the decision change. Now let us connect those flow numbers to what they actually do to Bitcoin's price structure, because the link between ETF flows and where Bitcoin trades is mechanical, not theoretical. When the ETFs were accumulating inflows through most of 2024, They functioned as what you can think of as a structural bid sitting inside regulated financial products. Every day that BlackRock's IBIT or Fidelity's FBTC were logging net positive flows, new money was entering the system through a channel that required the underlying Bitcoin to be purchased to back the shares being created. That was the ETF bid. Consistent, daily, powerful. It was the single most reliable source of marginal demand the Bitcoin market had ever seen. And right now, that bid has flipped. Glassnode, one of the most rigorous on-chain analytics firms in this space, described the consequence of this flip in their most recent weekly report in terms that should be on every serious Bitcoin participant's radar. They said, and I am paraphrasing because their language is precise, that the loss of the institutional ETF bid has pushed Bitcoin into a defensive regime. They defined that regime with two structural markers. The upper bound is what they call the true market mean, currently sitting near $79,000. The lower bound is the realized price, currently near $54,900. That wide corridor is where Bitcoin now lives, and Glassnode was explicit about what that range historically represents. Their words were a range associated with bear market absorption phases rather than active expansion. That is a significant characterization from a data-driven firm that does not use language carelessly. The true market mean is a metric worth spending a moment on because it is not a random line drawn on a chart. It tracks the aggregate cost basis of Bitcoin's economically active supply. Active supply meaning coins that have actually moved and been transacted with recently, not lost coins sitting dormant for a decade. When Bitcoin's price is above the true market mean, the average active market participant is in profit. When it is below, the average active participant is at a loss or near break-even. Bitcoin has been trading below that 79,000 level since the late January correction broke through it, and that positioning creates a structural headwind for rallies that most price-focused analysts do not factor in. Every time Bitcoin bounces toward that level, it puts a growing number of active holders back near their break-even or slightly into profit. And the instinct of investors who have been sitting underwater or at break-even for weeks is to sell on the way back up. Not because they are panicking, because they are relieved. That dynamic, the overhead weight of a market full of cost-basis sellers, is one of the primary mechanical reasons why every rally in this environment struggles to sustain. And the derivatives market is confirming what the flow data and on-chain structure are suggesting. Glassnode's data shows that funding rates across perpetual futures markets are currently neutral to slightly negative. Traders are not building leveraged long positions in any meaningful size. The speculative appetite that typically accompanies a market ready to move higher is simply absent. Options markets have retreated from the panic level implied volatility readings seen in late January, which tells you that the acute fear phase has cooled. But here is the nuance. The removal of panic is not the same as the arrival of conviction. Traders have stopped buying crash protection, but they have not started buying upside exposure in scale. The options market is effectively saying the market is not about to collapse, but it is also not about to launch. It is stuck. And derivatives positioning, when it sits in this kind of neutral limbo, tends to extend range-bound conditions rather than resolve them. Before we get to the macro backdrop, there is one more layer of on-chain data that reinforces everything the ETF flows are telling us, and it comes from a part of the market that most retail participants never think about. Miners. Bitcoin miners are the entities that secure the network and receive freshly minted Bitcoin as their block reward. And the way miners behave in any given market phase is one of the oldest and most reliable signals in all of crypto. When miners are holding their Bitcoin and not sending it to exchanges, it typically signals confidence in higher prices ahead. When miners begin accelerating their exchange deposits, sending freshly mined coins onto platforms where they can be sold, it suggests they are pricing in weakness and choosing to lock in revenue before price falls further. According to CryptoQuant data, miner outflows to exchanges have remained elevated relative to earlier cycle phases. Miners are not panic selling, but they are not aggressively holding either. The post-halving environment, where the block reward was cut in half in April 2024 from 625 Bitcoin to 3.125 Bitcoin per block, made miner economics significantly tighter. Operating costs did not change. Revenue in Bitcoin terms was cut in half overnight. And while the subsequent price appreciation through October 2025's all-time high helped many miners remain profitable, the extended correction since then has compressed margins again. Miners under margin pressure sell, and that steady background selling from the production side of the market is another reason why each recovery attempt runs into supply before it can develop into a sustained trend. It is not a massive force relative to ETF flows or whale activity, but it is a persistent one. And in a market already dealing with absent institutional demand, persistent background selling from miners creates a slow headwind that compounds the other pressures. The short-term holder data from Glassnode adds another dimension to this picture. Short-term holders are defined as addresses that have held their Bitcoin for less than 155 days. They are the most price-sensitive cohort in the market, the investors most likely to sell when they move into loss, and most likely to sell again when they recover to break even. Glassnode's short-term holder supply at loss metric, which tracks how much of the Bitcoin held by this cohort is currently underwater, shows that a meaningful but not catastrophic percentage of recent buyers are sitting on unrealized losses at current prices. The metric sat well below the 55% threshold that has historically been associated with full capitulation events. What that means practically is that the worst of the forced selling from recent buyers appears to have already occurred, but the overhang of holders who bought near cycle highs and are still underwater continues to create selling pressure into every recovery. Each time Bitcoin bounces, some of that cohort exits, not in panic, in relief, and that relief selling keeps capping rallies at successively lower levels until either the overhang clears through absorption or a major new catalyst creates enough demand to overwhelm the supply. Now here is where the analysis widens out beyond the ETF flows to the macro environment that is actually driving them, because institutional capital does not move in isolation. It moves in response to the entire landscape that fund managers are navigating. And what is happening in global financial markets right now is directly responsible for what we are seeing inside these Bitcoin funds. Bitcoin is down more than 20% year to date from where it entered 2026. That is a painful number. But the number that contextualizes it in the most important way is this. Over that same period, gold has been making consistent new all-time highs. The S&P 500 has outperformed Bitcoin year to date. And if you extend the window back through all of 2025, the picture becomes even starker. Bitcoin finished 2025 as one of the worst performing major asset classes of the entire year. Gold delivered returns above 55%. US equities were up double digits. Bonds posted positive returns. Bitcoin was down, and that outcome came despite a genuinely historic year for the regulatory and institutional infrastructure around crypto. Spot ETFs fully operational, a crypto-friendly regulatory environment under a new administration, a strategic Bitcoin reserve announced at the federal level, and still Bitcoin finished the year lower than where it started. That divergence between the expected narrative and the actual outcome is not something you can explain away with a single data point. It points to a structural story. The structural story is this. Bitcoin's relationship with macro forces has changed as it has become more integrated into traditional finance. It is no longer trading purely on its own internal dynamics. CME Group's research put it precisely. Bitcoin has evolved into what they describe as a liquidity barometer. When global liquidity is expanding, when monetary conditions are loose and risk appetite is high, Bitcoin tends to absorb capital and deliver outsized returns. When liquidity conditions tighten or uncertainty rises, capital gravitates toward assets with longer track records as safe havens, assets like gold, which central banks globally have been accumulating at record pace throughout 2025. The safe haven bid that the digital gold narrative promised would flow to Bitcoin has instead flowed to actual gold. And Bitcoin has been unable to capture it. That is not a reason to permanently write off Bitcoin's store of value argument. But it is a reason to understand that the conditions required for Bitcoin to capture that narrative have not yet been established in the way that gold's multi-decade institutional credibility has been. And the institutional behavior inside the ETFs reflects exactly this reality. Kronos Research's chief investment officer described the recent outflows as portfolio risk reduction amid rising geopolitical tensions and broader macroeconomic uncertainty. He noted that digital assets remain particularly sensitive to developments like trade disputes and tariff announcements, which have reinforced a risk-off atmosphere across markets. And here is the part that most retail participants underestimate. When institutional managers face an environment of elevated macro uncertainty, they do not necessarily sell the assets they have lost confidence in. They trim the assets that carry the most volatility and the least established macro credibility. Bitcoin is the highest beta major asset class in the world. Meaning when risk appetite contracts, Bitcoin feels it first and most severely. That is the deal that comes with owning the most volatile major asset class. The upside during expansion phases is extraordinary. The exposure during contraction phases is disproportionate. Now there is another dimension inside the ETF complex that deserves attention because it has implications for how the recovery, when it comes, will likely look. The concentration inside these funds is extreme. BlackRock's IBIT alone holds approximately 60% of all U.S. spot Bitcoin ETF assets, 60% sitting in one fund from one issuer, and IBIT's lifetime net inflows of approximately $62 billion are only modestly below its current assets under management, which means, according to analysis published by ETF.com, a significant portion of IBIT investors are only marginally profitable at current prices, and some cohort is underwater. When the fund that represents 60% of the entire complex has a significant portion of its holders near their cost basis or below it, every relief rally in price also becomes a potential exit ramp for those holders who want to break even and move on. That is additional overhead selling pressure that does not show up in on-chain data directly but materializes in ETF redemptions when price recovers. Meanwhile, something interesting is happening in the corners of the crypto ETF landscape that the mainstream narrative is missing entirely. Solana ETFs have been logging consistent inflows throughout this entire 5-week period when Bitcoin ETFs have been bleeding. XRP ETFs have seen modest but steady positive flows. The divergence is telling a story about how institutional capital is thinking about crypto exposure. It is not abandoning the space, it is rotating within it, moving toward assets with specific use case narratives and ecosystem development stories, away from the broad store of value Bitcoin exposure that was the dominant 2024 trade. If that rotation continues, it suggests a more sophisticated institutional engagement with crypto rather than a wholesale rejection of the asset class. But it also means that Bitcoin's path to recovering its ETF bid may require a distinct catalyst rather than just a general improvement in crypto sentiment. So what does all of this set up for? Let us build the framework of what would need to change for this current dynamic to reverse into a genuine expansion phase. Glassnode was direct about this. They said a durable recovery would require 3 things to come together. First, ETF flows would need to rotate back into sustained net inflows, not one positive Friday session that briefly offsets a week of redemptions. Sustained. Multiple consecutive weeks of net positive flows. Second, spot cumulative volume delta across major exchanges would need to flip from the current net negative reading, which signals active sell-side aggression, back to net positive, which would signal genuine buy-side absorption returning. Third, the accumulation trend score for large on-chain entities would need to climb from its current neutral reading of approximately 0.4 back toward higher levels that indicate high conviction positioning from major wallets. None of those 3 conditions are currently met. The accumulation trend score has moved away from outright distribution, which is a mild positive, but it has not entered the territory associated with aggressive large entity accumulation. The ETF flows continue to print negative weekly, and spot exchange data continues to show sell-side dominance rather than buyer absorption. This is not a permanent condition. These conditions have all been met before and will likely all be met again in this cycle. But they are not met right now. And trading as if they are met when they are not is exactly how participants get caught in false breakouts that ultimately reset lower. The Federal Reserve's posture is also a direct input into when those conditions might shift. The minutes from the January Fed meeting carried a hawkish tone. Language around patience on rate cuts, and the explicit acknowledgement that further tightening remains possible if inflation persistence continues. Rate cut expectations, which were a primary narrative driver for risk assets including crypto going into 2025, have been repeatedly pushed out by subsequent data that came in stronger than expected. And until the Fed actually materializes a credible easing cycle with either confirmed cuts or clearly telegraphed near-term relief, the institutional risk appetite that would translate back into sustained ETF inflows is likely to remain suppressed. The upcoming U.S. economic data, particularly jobs reports and inflation prints, are now functioning as direct upstream inputs into Bitcoin's ETF flow trajectory. Weaker employment data revives rate cut expectations. Rate cut expectations improve risk appetite. Improved risk appetite shows up in ETF flows within weeks. That transmission mechanism is the one to watch. Here is something else that is worth sitting with, because the Bitcoin on-chain floor story is actually more encouraging than the ETF flow story, and understanding the difference between those 2 narratives is critical for positioning correctly. Long-term Bitcoin holders, the wallets that have held through multiple cycles and tend to anchor the structural support of the market, continue to accumulate into this range. Exchange inflows have been declining, meaning coins are moving off trading platforms into cold storage. That is not the behavior of a market preparing for capitulation. That is the behavior of a market in distribution from sellers to longer-term conviction holders. Glassnode's realized price of $54,900 represents the average price at which all currently circulating Bitcoin last changed hands. And historically, Bitcoin trading near or above that level in a post-halving environment has been associated with eventual recovery rather than permanent breakdown. The halving in April 2024 cut the block reward from 6.25 to 3.125 Bitcoin. The reduced supply emission is still an active structural factor. New Bitcoin entering the market daily has been cut in half. And that supply dynamic does not care about ETF flows in the short term. It is a slow, persistent force that continues to apply pressure on the supply side regardless of what institutional allocators are doing with their portfolio exposure in any given quarter. So the honest picture is this. There are two competing forces at work simultaneously. On one side, the structural on-chain foundation is being built quietly by long-term holders absorbing distribution from shorter-term participants. The floor at the realized price of approximately $54,900 appears intact, and the post-halving supply dynamic continues to compress available float over time. On the other side, the ETF bid that drove so much of 2024's institutional momentum is currently absent. 5 straight weeks of outflows have removed roughly $3.8 billion from a product that was functioning as the market's most reliable structural buyer. And the macro environment, characterized by a hawkish Fed, gold outperforming, and elevated geopolitical uncertainty, is not creating the conditions for institutional risk appetite to return quickly. The resolution of those two competing forces is what determines what happens next for Bitcoin. If the macro environment shifts, if the Fed pivots or signals pivoting, if inflation data cooperates and risk appetite returns, the ETF flows can turn positive rapidly. They have demonstrated that capacity before. IBIT went from its current state to logging single-day inflows of hundreds of millions of dollars within short windows during favorable conditions in 2024. That institutional machinery still exists. It just requires the right conditions to activate. And when it does activate again, the on-chain floor that is being built during this absorption phase becomes the launchpad rather than just the cushion. Here is what you specifically need to track in the weeks ahead, and I want to be very specific because vague advice is useless in a market like this. Watch the weekly ETF flow number published every Friday from Soso Value or Farside Investors. 2 consecutive weeks of net positive flows after this streak would be the first meaningful signal of a regime change in institutional positioning. 1 positive week is noise. 1 positive day inside an otherwise negative week, like the $88 million inflow on Friday, February 20th, is also noise. What you need to see is back-to-back weeks where the cumulative 7-day total is positive and growing. If week 1 is positive 200 million and week 2 is positive 400 million, that is a pattern. That is the beginning of a trend. Watch for it, and do not mistake a single positive session for confirmation of anything. Watch Glassnode's accumulation trend score on their weekly report, which they publish every Monday. A sustained move from the current 0.4 neutral reading toward 0.6 and above over a 2 to 3 week period would indicate that large on-chain entities are building positions with conviction rather than sitting on the sidelines. And the key word there is sustained. A single spike in the score during a panic event, the way we saw the score briefly jump during the February 5th crash of last year before fading back, means less than a steady elevation of the score across multiple consecutive weekly reads. You want to see the trend in the score, not a single data point. When that score climbs and holds above 0.6 for 3 or more consecutive weeks, the on-chain positioning is telling you that smart money is loading up before the broader market recognizes the setup. That is the precondition for a sustained price recovery. That is the signal that historically precedes the phases where Bitcoin moves fastest and most aggressively to the upside. Watch the 70,000 price level as your confirmation threshold, because that level has specific structural meaning that goes beyond just being a round number. It represents the upper bound of the range where multiple important cost basis levels for institutional cohorts converge. A sustained hold above 70,000 over multiple sessions with genuine volume participation, not a single wick or an overnight move in thin liquidity, changes the structural interpretation of price action in a way that would be visible to every institutional desk monitoring this market. Below 70,000, the weight of evidence supports the range-bound, sell the rally interpretation. Above 70,000 sustained, the evidence begins to shift toward expansion being possible again. The bottom line is this. The era where Bitcoin ETFs provided an almost automatic institutional floor bid has paused. Whether that pause becomes a longer-term reset or simply a cyclical consolidation before the next expansion phase depends on conditions that are not yet in place, but are also not impossible to envision materializing within the next several months as macro clarity improves. The $54 billion in cumulative net inflows sitting inside these funds since inception is not at risk of disappearing. The $85 billion in net assets under management reflects genuine long-term institutional commitment to having Bitcoin exposure available within regulated vehicles. But the immediate marginal flow picture, the one that actually moves price in the near term, is negative. And it has been negative for 5 consecutive weeks in a manner that matches the severity of the most significant macro shock of last year. Understanding that context, understanding what it would take to change it, and understanding the specific signals that would confirm a reversal is in progress. That is the analytical edge that separates informed positioning from noise-driven reaction. Now you have it. Subscribe if you want more analysis built on data rather than narrative. Drop a comment telling me which of the 3 signals you are personally watching most closely right now. I read every single one, and I will see you in the next video.